All right, let's talk about a really interesting one today. Hello Group, who you probably know as Momo. They just reported earnings, and wow, the market's first reaction was, let's just say, not great. But as you're about to see, those initial headlines, they don't even begin to tell the real story.
So get this, the stock nosedives, down over 12% in the pre-market. Now a drop like that usually screams major disaster, huge miss. But here's the weird part. Hello Group actually beat on revenue. So what in the world happened? How does that even make sense?
Well, this is the number that sent everybody running for the exits. A GAAP earnings per share loss of negative 84 RMB fen. That works out to about a 12-cent loss per share. And the crazy part? Wall Street was expecting a profit of 29 cents. That is a gigantic miss. And you know, the trading algorithms just saw that number and hit the sell button hard.
But here's the thing, and this is the whole key to understanding this quarter. That shocking loss, the one that made the stock tank, it's a total head fake. It has almost nothing to do with how the company actually performed, operationally, day to day. You have to look past that big, scary headline number.
The entire story really just comes down to one single thing. A one-off accounting item. Yep, a single charge that's not even related to operations completely distorted the picture and made a pretty decent quarter look like an absolute train wreck. So here's the culprit. It was this almost 550 million RMB charge for a withholding tax accrual. Now, this wasn't a tax on the money they made this quarter. Think of it more like a catch-up payment for profits from past years, all because regulators decided to change the tax rate. So it's all about looking backward, not a sign of problems ahead. And this table just lays it out perfectly. You see that headline, the big minus 12-cent EPS miss. But then you look a little deeper, revenue, a beat. And this is the important one. Operating income was positive, over 400 million RMB. That tells you the actual business itself is still healthy and making money.
Okay, so now that we've cleared away all that tax noise, what is the real story here? Well, it's a classic tale of two halves. You've got this legacy business at home that's having a tough time, and then you've got this booming international business that's really starting to carry the team.
And I mean, the difference is just night and day. On one side, you've got the domestic business in China. Revenue's down 11%. And look at this. Paying users on the main Momo app got cut in half from a year ago. Ouch. But then, you look at the other side. The overseas business is absolutely on fire, growing 73%, mostly because of apps like Soulchill. It now makes up 17% of all their sales. That shift is the single most important thing happening at this company right now. So you see this split, right? Weakness at home, strength abroad. So what's the plan? What's management going to do about it? Well, their guidance for the next quarter tells you everything you need to know. They're basically saying expect more of the same. The total revenue number looks pretty flat, but when you look under the hood, they're predicting another drop in the domestic business while the overseas part is set for another massive growth quarter. We're talking mid-60s% growth. So the playbook is crystal clear. Pour fuel on the international fire while you try to stabilize things back home.
And as they're making this big strategic pivot, management has another tool they can use. They've still got over $185 million left on their share buyback program. That's a lot of firepower they can deploy to support the stock price and give back to shareholders while they navigate this transition.
All right, so let's put all the pieces together. Here's our official take on what to expect from Hello Group heading into their next report. This is the next call.
Our prediction is that this tale of two halves story is going to continue for a while. That overseas business will keep putting up amazing numbers, which will make the company's total results look pretty stable. But for the stock to really break out and get a higher valuation, investors are going to need to see some kind of spark, a real catalyst for a comeback in the main China business. So what does that mean for the stock price? Well, we think it's going to be stuck in a range for a bit, probably bouncing between $7 and $9 a share. The overseas growth should put a solid floor under the stock around $7, but that uncertainty in China is going to act like a ceiling, around 9 until something changes.
And for all those reasons, our rating is market perform. Look, the company's doing the right thing with its pivot, but the problems in its biggest market are still pretty serious. It's a really interesting transition story, but it's not a clear growth story. Not yet. So the big question is, can that international business grow big enough, fast enough, to become the new engine of the company? That's what we'll be watching.
And finally, as always, just a quick and important disclaimer. This is not financial advice. This analysis is for informational and educational purposes only. You should always do your own research and consult with a professional before making any investment decisions.